With all the market volatility right now, a lot of people are feeling uneasy about where things may be heading. Many economists have now pushed back expectations for interest rate cuts until later in 2026. In this video, we're going to break down what changed, what it could mean for your money, and how you may be able to protect your finances if this uncertainty continues. So, what changed? Just a few weeks ago, many analysts believed rate cuts would arrive much sooner. But now that outlook has shifted. More economists think rates could remain in the current 3.50% to 3.75% range through at least September. Some now believe there may be no cuts at all this year. That is a major shift because lower rates were expected to bring relief. Instead, the message now is simple: higher rates may last longer. Why did this happen? The biggest reason is inflation, especially energy prices. In the latest Consumer Price Index report for March, overall inflation rose to 3.3% year-over-year. Energy prices jumped 10.9% in just 1 month. Gasoline surged 21.2% in a single month, one of the sharpest increases on record, while fuel oil climbed 30.7%. Gasoline alone made up nearly 3/4 of the monthly increase in the inflation report. That is exactly the kind of move that gets the Federal Reserve's attention quickly. And this is where it becomes important. When gasoline rises, drivers feel it immediately. But diesel matters too, because diesel powers trucking, shipping, farming, deliveries, and many parts of the supply chain that move goods across the country. Recent Energy Information Administration data showed U.S. regular gasoline around $4.04 per gallon and diesel near $5.40 per gallon as of April 21st. Those are meaningful increases and help explain why inflation concerns returned so fast. There is another issue happening as well. Some refiners in Asia are cutting production runs because war-related supply disruptions have changed the crude oil available to them. Replacement barrels often produce less diesel and jet fuel than the Middle Eastern crude many refiners usually rely on. Reuters reported that the regional loss could reach as much as 2 million barrels per day of middle distillates. Why does that matter? Because if diesel remains tight, transportation costs can stay high, and those costs often spread into prices later. Even if the first shock began with oil, it can ripple through the economy afterward. So the issue is not just that inflation is high. The issue is that fuel shocks can spread. First to the pump, then into freight costs, delivery charges, and business expenses. If that happens, inflation can remain stubbornly high longer than expected. That is exactly why economists pushed back rate cut expectations. Their updated outlook for the Federal Reserve's preferred inflation measure now shows 3.7% in the second quarter, 3.4% in the third quarter, and 3.2% in the fourth quarter, still above the Fed's 2% target. Now let's talk about what this means for your money. First, this may still benefit savers. If rates stay higher for longer, CDs, money market accounts, and high-yield savings accounts may remain attractive longer as well. If you rely on interest income or have cash savings, that can be the upside. A delayed rate cut is not automatically bad news if your household is earning solid returns on safe savings. But the downside is borrowing costs. If you carry credit card balances, have variable rate debt, or expect to borrow later this year, higher rates staying in place means relief may not come anytime soon. And that can matter more than many people realize. Sometimes the danger is not one dramatic event. Sometimes it is a slow squeeze. Fuel costs rising, everyday expenses increasing, and interest charges continuing month after month. Then there is the market side. Earlier this year, many investors believed rate cuts were coming sooner. When that expectation changes, stocks and bonds can both become more volatile because markets have to reprice what they thought was ahead. Higher oil prices can make that even worse by adding more inflation fears. So this is not only about whether the Federal Reserve cuts rates. It is about what happens when markets must adjust again to a higher for longer environment. That is why I would break this situation into three groups. If you are mainly a saver, this environment may still work in your favor. If you are carrying expensive debt, it becomes more difficult. And if you depend on retirement accounts and feel nervous about market swings, the real question is whether your portfolio and cash position match your comfort level if volatility remains high. That is the practical issue behind the headlines. The headline itself is only the trigger. So what can you do right now? First, check your cash. If money is sitting in a very low-paying account, this kind of rate environment can cost you more than people think. When rates stay high, the difference between a weak savings account and a better one becomes more important. Second, take a serious look at expensive debt, especially credit cards or variable rate balances. If cuts are being delayed, waiting for cheaper borrowing may not be the best plan. Third, be honest about your risk level. If recent market swings are making you uneasy, the answer may not be panic. It may be reviewing whether your current setup is too aggressive for the kind of year we may be facing. Those are the three areas this headline touches most directly: cash, debt, and risk. And the biggest thing to watch from here is still inflation, especially fuel prices. If gasoline and diesel cool down, inflation pressure could ease, and the rate story may change again. But if fuel stays elevated and continues flowing into transportation and delivery costs, then rates may stay high longer than many people hope. That is really the heart of the story. It is not just about one Federal Reserve decision. It is about whether energy prices keep feeding inflation long enough to delay relief. So what do you think? If rates stay higher for longer, does that help you more through better savings yields, or hurt you more through higher bills, expensive debt, and market volatility?